Welcome to the Opening Bell Report.
Our mission today is to unpack a really fascinating analysis report we've been going through. It's regarding applied digital ticker symbol APLD.
Yeah.
And the core focus for us and for you listening is understanding exactly why APLD's revenue just exploded.
It really did.
And what comes next as they execute what has to be one of the most aggressive and lucrative pivots in the entire tech sector.
Wow.
They're basically positioning themselves as the ultimate picks and shovels play in this current AI gold rush.
Which is really the perfect lens through which to view their strategy. Everyone else is rushing to find the gold, right? They're trying to build the winning AI software or the ultimate large language model.
Right.
But historically, if you look back, the entities that consistently generate massive, reliable fortunes during any gold rush, they are the ones selling the tools.
Building the road.
Building the road, supplying the miners. If you, the listener, have been watching the pretty wild stock market volatility in early 2026, Applied Digital has been front and center of that infrastructure conversation.
Yeah.
They are the ones actually pouring the concrete, fitting out the liquid cooling, and running the massive power lines.
And that brings us to the central questions we are exploring with you today. Like, how did APLD manage to explode their top-line revenue by 250%?
Which is a crazy number.
Yeah, it's massive. And perhaps more importantly, what are the actual mechanics behind their $16 billion roadmap for the future? We're going to decode the financial moves, the scale of this infrastructure build-out, and obviously the risks involved. So, okay, let's unpack this.
Let's do it.
Starting with the sheer scale of the numbers from their most recent quarter, because they really set the baseline for everything that follows in this analysis report.
Yeah, the Q2 2026 numbers definitely act as like a dividing line for the company.
Yeah.
They absolutely blew past standard earnings expectations.
Yeah.
They posted $126.6 million in top-line revenue.
Which translates to that staggering 250% year-over-year increase.
Yeah.
I mean, when you see a legacy tech or infrastructure company jump 250% in a single year, it's a clear signal that something fundamental has completely shifted beneath the surface.
It's not normal.
Right.
Yeah.
It isn't just organic growth. It's a structural transformation of their entire business model.
And that transformation is the key to that $126.6 million quarter. Applied Digital executed this massive pivot away from their original identity.
Right, the crypto stuff.
Exactly. They were a legacy cryptocurrency mining host, and they just abandoned that model to become a pure-play, high-performance computing powerhouse, HPC.
And people need to understand the physical requirements of those two industries they're worlds apart.
Well, completely. Cryptocurrency mining basically requires cheap power, some basic metal racks, and heavy airflow in a warehouse. You're just blowing air over machines.
It's just massive fans.
Right. But high-performance computing, specifically for generative AI, it requires an entirely different universe of infrastructure. We're talking about facilities engineered to handle hundreds of pounds of server weight per square foot.
Because the GPUs are so dense.
Exactly. You need specialized liquid cooling loops, massive fiber optic trunks. You can't just put AI chips in a crypto warehouse.
And that physical complexity feeds directly into their bottom line. The analysis report highlights a very specific detail here that I love. Out of that $126.6 million in recent quarterly revenue, $73 million came strictly from fit-out services.
Right.
For anyone tracking commercial real estate or data centers, you know that leasing space to an AI company isn't just about handing over the keys to an empty air-conditioned warehouse.
Far from it. If you hand an AI software giant an empty building, it's essentially useless to them.
They don't know what to do with it.
Right. Major players like CoreWeave, who, by the way, are heavily featured in the report as a primary client, they are scaling so fast that they simply do not have the time, or the general contractors, or the specialized workforce to build out the interior of these facilities.
They write software.
Well, they're compute providers, right? Not construction companies. So Applied Digital provides a fully turnkey solution. They execute the bespoke, highly complex interior construction required to house next-generation high-density GPUs. They are building out what are essentially bespoke AI superfactories.
Which means they capture revenue not just on the rent.
Exactly.
They capture it on the massive capital expenditure of the build-out itself. They are monetizing the hardest part of the process.
And what's fascinating here is how the physical infrastructure has emerged as the single most critical bottleneck for AI growth globally.
Totally.
You can have the capital to buy the fastest, most advanced chips on the market, but if you don't have a specialized facility with hyper-dense liquid cooling systems and utility-scale power feeds ready to accept them,
the chips just sit in boxes.
they just sit there. Because Applied Digital can execute this turnkey construction for massive hyperscalers, they've unlocked an incredibly lucrative revenue stream. They are solving the physical bottleneck.
That dynamic perfectly contextualizes the 250% revenue explosion. But the analysis report makes it very clear that the recent quarter is really just the rearview mirror.
Yeah, that's done.
Wall Street is completely laser-focused on Applied Digital's windshield. And looking forward, their prospective lease pipeline is operating on a scale that honestly forces you to rethink standard tech valuations.
The pipeline they've constructed is easily one of the most aggressive and lucrative we've seen in the modern data center space.
They have locked down approximately $16 billion in prospective lease revenue.
Billion with a B.
16 billion. And the detail that really stands out to me is that this revenue is spread across 15-year contracts.
Yeah, that's the kicker.
If you consider the standard tech cycle, hardware becomes obsolete and is replaced every 12 to 18 months, right? Getting major tech players to sign a 15-year ironclad agreement is almost unheard of in traditional software or hardware cycles.
It speaks volumes about the absolute desperation for guaranteed power. These major AI players have incredible long-term conviction that their computational needs are only going to compound.
They know it's not slowing down.
They know they will need dedicated utility-scale power for the next decade and a half, and they're willing to legally lock that in today, regardless of what happens to specific chip architectures in the meantime. The chips will change, but the power need won't.
Let's translate that $16 billion into physical reality because the scale is immense. The report breaks down that this revenue is tied to 600 megawatts of capacity located across their North Dakota campuses.
Right.
And to put 600 megawatts in perspective for the data center industry, a standard large-scale enterprise data center might pull anywhere from 10 to 20 megawatts of power.
Tops.
So 600 megawatts is essentially grid-level power draw. It's the equivalent of powering dozens of standard data centers concentrated for just a couple of clients.
And those clients are the absolute heavyweights. The capacity is leased to CoreWeave alongside another unnamed US-based investment-grade hyperscaler.
We should probably define what that means in this context because the term hyperscaler gets thrown around a lot right now.
Yeah, it's a buzzword.
When we talk about an investment-grade hyperscaler, we are talking about cloud providers operating at such a massive global scale that they essentially dictate the supply chain. They have the balance sheets of nation-states.
Literally.
So when they sign a 15-year lease, banks and investors view that contract as virtually default-proof cash flow.
Exactly, which is why management feels confident releasing their upwardly revised growth targets. They aren't stopping at 600 megawatts. Their vision extending into the 2030 to 2032 timeframe lays out a clear path to hit 5 gigawatts of capacity.
5 gigawatts. That is a monumental leap from where they are today.
It is a staggering scale-up.
Yeah.
And hitting those targets completely transforms their financials. The projection is that they will cross the $1 billion mark in net operating income, or NOI, within the next 5 years.
And for anyone less familiar with real estate metrics, net operating income is essentially the total revenue from the properties minus the operating expenses.
Right.
It's the pure cash flow generated by the assets before taxes and financing costs.
Yep. And hitting $1 billion in NOI is a massive milestone. If we connect this to the bigger picture, you can see exactly why Wall Street is analyzing this so closely. When you combine 15-year leases, investment-grade hyperscaler clients, and a clear path to $1 billion in pure cash flow, you are generating massive, high-margin, highly predictable revenue.
Institutional investors love predictable.
They absolutely love it. It removes the guesswork from long-term valuation models. But there is a massive execution caveat here.
Oh, there always is.
All of that $16 billion in the pipeline and that $1 billion in NOI is entirely dependent on them actually finishing the construction of these mega facilities.
You can't collect rent on a blueprint.
No, you cannot.
You have to finish the building, power it up, and hand over the keys. And building out 5 gigawatts of hyper-dense AI factories requires an astronomical amount of upfront capital. Which brings us to, here's where it gets really interesting.
Okay.
Because we have to tackle the $2.15 billion elephant in the room, which is the state of their balance sheet.
It is the unavoidable hurdle. You have to look candidly at how a company finances the future when the future costs billions of dollars to build out in the present.
On March 4, 2026, Applied Digital announced the pricing of $2.15 billion in senior secured notes. When you stack that on top of their existing obligations, it pushes their total debt load to roughly $2.6 billion.
Yeah.
Now, if you're analyzing a company that just posted $126 million in quarterly revenue, suddenly seeing a $2.6 billion debt load is the kind of metric that naturally spooks a lot of casual investors.
It's a very intimidating ratio at first glance, but we need to recontextualize the specific nature of that debt. Taking on billions in debt isn't necessarily a panic moment in the infrastructure sector. The analysis report makes a crucial distinction here that changes the math entirely. This is strictly project financing.
And the distinction between project financing and corporate debt is really the linchpin of their entire strategy here. When a company takes on general corporate debt just to keep the lights on, to fund everyday operations, or to cover payroll.
That is a glaring red flag.
Exactly. That's a company burning cash just to survive. But project financing is an entirely different mechanism. These funds aren't being dumped into a general checking account. They are structurally ring-fenced and strictly earmarked to build a very specific physical asset that will generate its own dedicated revenue stream.
And the analysis report details exactly where that capital is flowing. The funds from that $2.15 billion raise are earmarked specifically to build out the 200-megawatt Polaris Forge 2 campus.
Up in Harwood, North Dakota.
Right. The debt is tied entirely to that specific physical campus.
But even with project financing isolating the risk, there is still a massive execution risk to consider.
Oh, absolutely.
They still have to physically build a 200-megawatt campus on time and on budget. If global supply chains stall on those specialized liquid cooling units, or if there are labor shortages, that facility doesn't open on time.
Right, and the projected revenue gets pushed back.
But the interest on that $2.15 billion in debt starts ticking up immediately.
That is the friction of the construction phase. You are absolutely right that execution is the variable that can compress margins here. But the counterweight to that risk, and the reason the financing was secured in the first place, is the projected return on investment once the facility is energized.
The payoff.
The massive payoff. Yes, they are taking on $2.15 billion in debt. Yes, they are burning cash right now and navigating significant short-term financial friction. But the Polaris Forge 2 campus is already pre-leased. Once it is built and fully powered, that single 200-megawatt campus is expected to generate $5 billion in revenue over its lifespan.
So it's a matter of enduring the immediate pain for the long-term payoff. When you weigh a $2.15 billion construction loan against $5 billion in guaranteed pre-leased revenue from investment-grade clients, the massive debt load suddenly stops looking like a desperate liability.
It was completely different.
It starts looking like a very deliberate, well-calculated leverage play to unlock a massive pipeline.
It completely reframes how you view the balance sheet. They are weaponizing debt to capture market share, while the hyperscalers are desperate for space.
It's a calculated risk, but a logical one. That being said, if we are talking about things that might spook an investor or cause a double take, the report also addresses a massive headline that definitely caused some whiplash recently regarding one of the biggest names in tech.
Oh, yeah.
NVIDIA just exited their equity position in Applied Digital entirely.
NVIDIA rotation.
It's a fascinating dynamic. NVIDIA sold 7.7 million shares of APLD, which amounted to a $182 million exit.
Yep.
And if you are just scanning the financial news and you see that the most dominant AI chip designer in the world just dumped every single share they owned in an AI infrastructure company,
right,
that looks like a glaring operational red flag. So what does this all mean?
It's completely understandable why a casual observer would view that headline as a shockwave.
It sounds terrible.
It sounds like a vote of no confidence. But to really analyze this, we need to look at how strategic venture capital actually functions within the AI ecosystem. NVIDIA is a chip designer and a software ecosystem. They are not a traditional long-term real estate holding company.
Right. Their venture capital arm operates with a very specific cyclical mandate. They strategically seed early-stage companies to help accelerate the broader AI infrastructure.
Exactly.
They are essentially ensuring that the ecosystem is ready to support their latest generation of chips. But once those infrastructure companies hit a certain maturity level, scale up, and secure their own institutional funding, like a $2.15 billion debt raise, NVIDIA liquidates that equity position.
They've done their job.
They free up that capital to deploy it into the next emerging bottleneck somewhere else in the supply chain.
Precisely. The fact that NVIDIA sold their $182 million stake is a standard life cycle event for their venture capital wing. It is not a reflection of Applied Digital's operational health or their ability to execute. In fact, you could argue it proves APLD has reached a level of maturity where they no longer need NVIDIA's equity backing to secure capital.
And the analysis report explicitly backs that up, noting that the core business fundamentals and the physical demands haven't changed at all. Applied Digital is still out there actively building the exact hyperdense, liquid-cooled data centers that are strictly required to house NVIDIA's high-performance chips.
The underlying physical relationship remains totally intact. The global demand for these pristine, specialized compute environments is still soaring. NVIDIA's customers still desperately need companies like Applied Digital to build these superfactories, regardless of whose name is on the equity shares.
Right.
The infrastructure demand didn't vanish just because a venture capital arm reallocated its portfolio.
Which really highlights the danger of trading on headlines without understanding the mechanics underneath them.
This raises an important question for you, the listener, whenever you are evaluating early-stage, hyper-growth sectors. How do you differentiate between a standard strategic venture capital rotation and an actual fundamental flaw in a business model?
It's tough.
It is. But in this specific case, the analysis makes it clear that the core business model, the massive contracted lease pipeline, the turnkey fit-out execution, the 15-year hyperscaler agreements remains incredibly solid. The foundation hasn't shifted.
That is such a vital distinction to keep in mind, and it perfectly sets up the bottom line of today's deep dive. If there's one core takeaway you should hold on to from this analysis of APLD, it is that they are playing the ultimate long game in the AI revolution.
They are absorbing all the friction right now. They are enduring the short-term pain of massive capital expenditures, navigating supply chain risks, and taking on billions in debt to build out these mega campuses.
The construction of locations like the Polaris and Delta Forge campuses requires incredible upfront sacrifice. But all of that heavy lifting perfectly positions them to collect on a $16 billion recurring lease pipeline over the next 15 years.
Yeah.
While everyone else out there is obsessing over which tech giant is going to write the best generative software or which specific neural network algorithm is going to win the day, the most predictable, reliable fortunes might just be made by the companies pouring the concrete, fitting out the server racks, and running the liquid cooling pipes.
This is the purest definition of an infrastructure play. You don't have to bet on which AI software model wins the market if you own the physical building where all of them are forced to pay rent.
Exactly.
But to leave you with a provocative thought to mull over something that steps just outside the immediate bounds of this financial analysis.
Let's hear it.
Applied Digital is locking these hyperscalers into 15-year leases based on today's massive, frankly staggering power requirements. We're talking about 5 gigawatts of projected capacity. But what happens if AI models become significantly more computationally efficient over the next decade?
That is the wild card in all of this.
Exactly. If the software and the hardware evolve to require far less power and far less physical footprint to achieve the exact same computational results, how will that efficiency shift impact the rigid, multi-gigawatt infrastructure bets being made today?
That is a heavy question to consider. If the technology becomes infinitely more efficient, do these hyperscalers still need 5 gigawatts of grid-level power, or does the demand profile completely change?
Time will tell.
It is a fascinating variable to watch in the coming years as this $16 billion pipeline actually plays out in reality. Well, thank you so much for joining us on this deep dive into Applied Digital, the mechanics of project financing, and the fascinating world of AI physical infrastructure. Keep an eye on those heavy construction sites, and we will catch you next time.
Don't forget to like, share, and subscribe for more.